Stocks drift lower after a strong start with advances and declines evenly balanced. Energy and healthcare stocks are prominent gainers, even as financial and capital goods are the soft spots today.
After TCS's strong show, HCLTech reports growth ahead of estimates with in-line margins. The company also holds on to its FY25 revenue and margin guidance.
MRF announces a hike in tyre prices for commercial and passenger vehicles from July 18th. The move coming on the back of rising costs boosts sentiment for all the other tyre stocks, where the gaining pack today.
Aurobindo Pharma gains on weighing its maiden buyback. Strong asset growth lifts IREDA, and Tanla Platforms gets a fillip from a global tech major's contract. But even Suven Pharma sulks in getting 2 US FDA observations for its unit. Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Mangalam Malu. Well, it is turning out to be a session where we've started in the green, so no problems really coming in there. It is going to be a truncated week for us, but nonetheless, the mid-cap index as of now is outperforming with a gain of around 0.6%. We do have the June WPI data, which is flashing on your screen, so that's come in higher on a month-on-month basis. It's hardened to around 3.36%. versus 2.6% on a month-on-month basis. We do have Lata in the studio to tell us more about the analysis there. Lata, over to you.
Well, this is on expected lines. Not too many people give you advanced estimates of WPI, but I was getting a number of about 3.5%, if I'm not mistaken. There is, it's almost there, 3.4% is the inflation. We must remember that we are starting to get positive numbers because the base is now becoming like extremely negative. All of last year we had minus numbers in WPI, and that's why now you have started to get positive numbers. As you can see, month on month also there's an increase in the WPI number, but just look at the vegetable inflation. Onion inflation at 93%. Eggs, meat and fish, okay, that's not the big number. We should be looking at the food inflation, or what in WPI you call primary markets inflation. Food inflation 8.7% versus 7.4%. Vegetable inflation, as you can see, month on month as well, very high. Cereals inflation at 9.3%. So this is a food-driven inflation, no two ways about it. But I would want to look at the manufacturing inflation as well, because there could be a bit of the end of the fall more in manufactured products. As you can see, 1.4% compared to 0.78. The extent to which global prices are falling is stopped, and now there is a bit of an upside. But more importantly, at some point in time, you know, even the telecom things will start factoring in and could get into wholesale prices of other things. The telecom rates is a CPI issue. It's a consumer price issue. But it gets into, you know, the costs of companies, and that can also push up other wholesale products. So there it is. Today the story is largely a food inflation story as far as the WPI is concerned. But I think it's important to note that the fall in manufacturing prices has also stopped, and now you are starting to get a 1.4% manufacturing products inflation as well. With that preface, I think we should invite the guest. Upasana Bharadwaj, Chief Economist at Kotak Bank, has joined us. Upasana, this number 3.4 WPI itself, is that something we should worry about? Because this is the one that also starts entering the GDP and the you know, current prices of GDP.
Yeah, Lata, you would see that, as you mentioned, the split is largely led by the food inflation. So we knew that WPI inflation, the base effects that were favoring it are now beginning to be arrested, and now we would be seeing higher and higher numbers irrespective. And to that, we of course have is the food-led inflation. So overall, the month-on-month momentum is clearly higher. And this may continue going into the next few months as well, because, you know, the lagged impact of the heat waves and all is going to be playing out for maybe 1 or 2 months more before we start seeing the impact of the monsoons really on arrivals. So till we don't see really that, the near-term risks on food remains. And at the same time, the tide is already turning for WPI. So yes, it will start reflecting in the GDP deflator at some point in time. from Q2 onwards, irrespective, the deflation story that in WPI we were seeing is likely to be now in positive and more positive as we go ahead. So overall, we could be seeing closer to 4.5% to 5% readings as we exit the year in WPI as well.
What's your sense about CPI as well? Are you revising any numbers after the higher than expected inflation in June?
Lata, there are two parts to this. At this point, we know that much of the inflation which surprised us on the upside has been led by vegetables. If we do a CPI X vegetables, then it's fairly stable, steady at around 3.5%. Previous reading was also 3.5%, and the previous reading was also close to 3.6%. So last 3-4 readings, rather, most of 2024 has been steady around 3.5%, plus minus a little. So I think immediately we're not really looking to revise our numbers because vegetable prices tend to be very volatile, and we do tend to see a lot of correction in the subsequent months. The important part is that the Kharif sowing is picking up pace. And two important structural factors which we tend to look at in the food category is cereals and pulses. There, the sowing pattern is very, comforting. And that's where hopefully, we will see some easing out on food price pressures eventually as we see the winter months and all. So I think through the course of the year, we will see some normalization. So at this point, 4.5% is what we retain. Of course, at the same time, we have to remember the telecom tariff hikes, like you mentioned before. That is something which will put an upside pressure to headline, but more so to core inflation in the coming 2 to 3 months, depending on how it really pans out. So the core inflation momentum is where we'll have to be much more cautious about because growth is holding up quite well. So apart from, base effects not being favorable for core, tariff hikes being reflected, the core inflation getting a support from demand-led is also what we have to keep in mind. So I would be more cautious on observing the core inflation trajectory rather than food, because food we know is very volatile and it tends to correct also equally well.
Fair point. Fair point. Actually, to your point about core inflation in the current index as well, the manufacturing index has gone up 1.4 year on year, but month on month also there is a 1%, there is a 0.1% increase month on month. So at least the fall is over of core because the month on month number is slightly higher. Just a final point, Upasana, what do you make of now rate cuts? The governor's interview was very emphatic. He said premature even when I asked him stance. But regardless, globally there is, the US bonds have now fallen to even below 4.2. ECB has already cut and probably the Fed cut is now a given in September. Given all this, where would you place the first RBI cut?
Lata, like you said, global conditions are turning fairly benign. So let's keep that aside. Domestically, we will have to be cautious on inflation, and Governor has, very adequately cautioned us against acting prematurely. So we have been of the opinion that earliest rate cut can happen is in December, and that too, we'll have to be very watchful on that. Talking about the stance, if you see the financial conditions have already eased. Conditions on liquidity is very ample, and as a result, the overnight rates are below repo rate for most of the time. Lately. So I think, just the phrase withdrawal of accommodation is something which doesn't have too much of meaning till RBI doesn't really act on that. But I would say that the markets have already settled to this easy liquidity for now because government is spending. This is a time when currency leakage is minimal. And we do expect that this whole quarter is going to be ample in terms of liquidity, which means money market rates remain fairly comfortably low. As a matter of fact, if you look at the T-bill issuances in H1, overall, it's a net issuance, which is negative. So all in all, conditions on the lower segment of the yield curve, let's say, the lower end of the curve is looking very comfortable. So the financial conditions are already benign. And I don't see too much emphasis on the need to shift their stance right away. Earlier as well, they have mentioned that they could very well, possibly indicated that they could change the stance when they do the rate cut as well. So, it could be a December change in stance, or it could be February, whenever they do choose to do the rate cut. And I don't see a rate cut possibility before December. Let's put it like that.
Okay. Okay, okay. Some of your peers have also put it to next year. No cut in December, no cut in 24 at all. At least you're holding out a hope in December. Upasana, thank you very much indeed for joining us with your thoughts on the bond markets, on the possible Reserve Bank policy and on the inflation trajectory. So the news from the inflation numbers is it is slightly higher than expected. As far as CPI is concerned, WPI is mostly on expected lines. 3.5 was expected. But the big point is food inflation is higher and manufacturing inflation has bottomed out. So inflation is not coming down in a hurry, but that is not a very big bother. Because of global conditions, bond yields have remained under control, and the very big trigger that we are expecting for bond markets and for the cost of money, for interest rates, is not really from the Reserve Bank, but from the government, from the budget. And there, the government is now in a happy position of higher than expected revenues, both tax and non-tax. So there is a very big expectation that the fiscal deficit will be lower, and there might be, with a good chance, even market borrowing by the government falling. So bonds in a happy spot, but let's see what July 23 holds for us.
Okay, all right, Lata. Thanks very much for that. So that's the update coming in on the WPI data. 4.5 to 5% is what we could probably expect in terms of WPI by the year end, and the core inflation trajectory is something that we should probably be a little cautious about. We'll take a short break. On the other side, we'll bring you snippets from our exclusive conversation with the RBI Governor Shaktikanta Das. Stay tuned.
Sitting with a 100-point gain, 24,601. That's a fresh record high for that index. In fact, as we speak, it's the auto stocks which are doing extremely well. So we have Bajaj Auto, which has moved to the high point of trade. Reliance, a stock which was underperforming for most part of the day, has now moved off the lows, a good 0.75% off lows. And that's what's explaining the kind of up move that we're seeing on the Nifty as a result of that. So Reliance was in the red for most of today's trading session and now has moved mildly into the green, and that's taken the Nifty to above 24,600 as well. But let's get you an exclusive conversation that our colleague Lata Venkatesh had with the RBI Governor Shaktikanta Das. Spoke about interest rates, the stance, and a lot more. Here are a few excerpts from that conversation. Come back, we focus on the markets once again.
Now, when you talk of interest rate cut, now, of course, everybody always, at any point of time, everybody talks about interest rate cut. There is another whole lot of people who are the depositors, the silent depositors, who are, who would be affected in a different direction. Now, that is one aspect. Now, when the inflation is at 4, our inflation, the last print was 4.7%. And the June inflation is expected to be, out tomorrow. That is also expected to be, as per the surveys done by various wire services, that is likely to be close to 5%. So when we are at 5 and our target is 4, I would feel it is too premature to talk about interest rate cuts. Now, some central banks do some kind of advance guidance saying that, it is not far away, or, we are getting close, something like that.
That was my ask.
Yeah, but the issue is the overall economic environment globally, not just in India, globally and in India, it is so uncertain to talk in terms of interest rate cut that I will do it, 1 quarter away or 2 quarters away. You say something and then you have to sort of take back whatever you have said today. So basically it is the uncertainty which is the one aspect. Second thing is the CPI headline inflation continues to be close to 5%. In fact, as I said, according to the surveys done, it's likely to be again expected to be close to 5%. So therefore, from that context, I think it is too early to talk about interest rate cuts. And I would rather not give, any kind of forward guidance, which may, I said it, I think, somewhere else. I would not like to give any kind of forward guidance which would lead the market players and the stakeholders and others to board the wrong train.
Okay. The stance has remained unchanged for a goodish bit. What do you think, and what will make you change it?
You see, the stance has been, we have called it withdrawal of accommodation,
Yes.
and there is a reason for that. Target is 4%. We are nowhere near 4%. We are still around 5%. But the expectation is that it is moderating, and it is indeed moderating.
Yes.
But the pace of moderation is very, very slow. It was 5.1, then I think it became 4.9, then 4.7. So it is moving very slowly. Now, one idiosyncratic development of some monsoon, flooding or some weather-related event can upset things. The vegetable prices can go up. So therefore, and the point is, even today we are still around 5%. So if we want a faster alignment of our inflation with 4% target, the monetary policy should be much tighter.
Okay.
It should be much tighter, it should be much more restrictive. But we have not done it because we do a balancing between growth and inflation. So therefore we have not done it. We have chosen a calibrated path to aligning the inflation with the target. So therefore we are still quite a distance away from 4% target. Given the distance that we have, which is currently 70 basis points, which may go to 80 basis points, given this much of gap, I think it is, it will be too early to talk in terms of change of stance. Okay. Unless you are somewhere close to 4%. You see, unless you are somewhere there, the question of changing of stance, I think, will be very premature. Okay. It is quite possible. Like, the second quarter inflation number is expected to be lower. But then again, it is expected to go up. Yeah. Annual average, we have said 4.5%. So when we move towards 4%, on a kind of a sustained, durable basis, only at that point we may get a confidence to have a relook. Okay. I'm saying to have a relook, not okay. More than that.
Okay.
Okay, that's the RBI Governor. We need to take a short break, but up next we'll be discussing technical. Sudeep Shah of SBI Securities will join in with some trading calls.
Welcome back. Close to a record high on the Nifty, and that's exactly what we're looking at when it comes to all the setup coming in from the F&O space itself. So you look at the Nifty, it's closer to the record high. We have, the key indices today, which are in focus. We have the Nifty IT index, which has been doing well for the last couple of trading sessions. Today as well, holding up in the green by about almost 0.5%. The Nifty Bank 2, which was actually underperforming, saw a bit of an improvement, and from there itself it saw a bit of a selling. So the Nifty Bank is the problem pocket, but despite the Nifty Bank moving off highs and mildly into the red as we speak, what's kept the Nifty afloat is actually Reliance. So important to track Reliance from here on as well. If you just look at the intraday chart, you would see the stock, which was mildly in the red, had moved mildly into the green and has moved off low. So to that extent, it will be very important to see how both the Nifty Bank as well as the Reliance stocks perform for the Nifty to have a significant move on either side. But the fact that we broke out on Friday and continue to hold on to higher levels today tells you that the base for the market has moved higher, and that's what put writers are hoping for as well. 24,500 put has seen a fair amount of writing, as is the 24,600 put, telling you that the earlier congestion zone of 24,450 to 24,500 will now be an important support. So 24,500 is a mark that one is looking at the lower level itself. But on the way up, 24,650, 24,700 will continue to be a bit of a resistance. That's what call writers at 24,600 are hoping for as well. And there are signs for congestion at the top as well. What are those signs? One, the India VIX has moved higher by about 3% at a time when the market's continuously moving higher. The Nifty put call ratio itself has moved near 1.3, and we have nearly 11 stocks in F&O ban, and this is just the second or third week of the July series. So those are important levels to watch out for. India VIX will continue to move higher as we move towards the budget itself. A couple of stocks that I'm watching out for. Ekta has been telling us about all the pharmaceutical updates coming in. A lot of long positions added on both Aurobindo Pharma as well as Alchem Lags. And then you have names like Mahanagar Gas, India Mart and Colgate, all of them seeing some bit of long positions as well.
Okay, all right, Manglam, thanks very much for that. Well, Sudeep Shah of SBI Securities joins in to discuss the technicals now. Sudeep, hi, welcome to the show. Well, it is a good session for the mid-caps at least. Can you give us a sense in terms of what you're tracking today and what would your call be on the markets?
Good afternoon, Ekta and Mangalam. Yeah, so see, while Nifty is in a overall uptrend, we are seeing specific pockets such as IT, FMCG, oil and gas space showing signs of bullishness even at higher levels. So this is helping Nifty sustain at higher levels, and therefore we feel that buying on dips would be advisable for the next few sessions. We feel overall 24,300, 24,350 zone, which is the 20-day exponential moving average, will act as a strong support until the time this zone is guarded. Overall upside up to 24,780, 24,900 could be on the cards. And this is also supportive by the put writing data, where put writers are now shifting to 24,400 and 24,500 strikes. So we feel overall, all in all, with the kind of sectoral rotation we are witnessing, it is going to be bullishness, and buy on dips would be advisable for Nifty. From a bank Nifty standpoint, bank Nifty is in a tight range in the last few sessions. We feel a move above 52,450, 52,500 is required for the bank Nifty to break out of this concession zone, and then bank Nifty would be on course towards 53,100 kind of level. So 52,500 would be the most important level that we are watching out for in terms of bank Nifty.
All right, and individual stocks, Sudeep, what do you have on your list right now? What are the stocks that are making for compelling buys or sells at this hour?
Mangam, we have a couple of buys now, one from the cement space and one from the power space. So from the cement space, we have UltraTech Cement, wherein post a big move in the month of June from 10,800 to 12,000, the stock had been consolidating in the last few sessions. It has taken support at this 20-day exponential moving average since the last 5 sessions, and now the stock is on its way up once again. So we feel that from the current levels, with all the time frame, with all the charts on different time frames looking positive, this stock is headed up to 12,300, 12,500 in the next couple of weeks, and this could be bought with a stop loss at 11,600 on the downside. The second stock is from the power space. That is NTPC. So this stock also in the last 2.5 to 3 months has been consolidating between 350 and 370, 375 on the upside. And in the last few days, we are seeing signs of accumulation at lower levels, and this is holding above all its key moving averages also. And today we are seeing good price action here. So we feel that there could be a breakout soon in this counter. And this could be bought with 375 as a stop loss on the downside and 400, 415 as a target on the upside.
All right, take that point. Thank you, Sudeep, for joining in with your views. Take a short break, come back. We'll get you more on the stock-specific action on the other side of this edition of Halftime Report. Welcome back. You're watching us here on Halftime Report. A bunch of stocks which are doing well, among which the one that stands out is Godfrey Phillips, and the other one is actually Parag Milk. So just take a look at the intraday chart of Parag Milk. Volumes picking up. Remember, the stock has seen a bit of a decline from its 52-week high, almost 35%. The question was whether the milk cycle is now turning for the obverse, with all these companies seeing a gross margin reduction. We'll keep an eye out on that one. And the other one is Godfrey Phillips. And today's results of Hatson Agro will be extremely crucial to watch out for as a commentary on the dairy industry itself. Godfrey Phillips, on the other hand, up 17% today. This year, it's up 125%. The earlier part of this month wasn't a big mover. With today's up move, it's actually moved higher for the entire month itself. And over the last 12 months, the stock has nearly tripled, almost 190%. Over the last 6-7 quarters, their volume growth has been higher than that of ITC and VST industries, telling you that they have been gaining market share. And they're also looking to leverage on their distribution by selling newer products apart from, the tobacco that they sell under Philip Morris brands itself. So those are a couple of things that we'll keep an eye out on. The budget will be a big imponderable for all these tobacco-related names. Zomato is the other one that we're talking about. Why is that? The stock has hit a fresh record high today. They've increased their platform fees from 5 rupees to 6 rupees. Now, this 1 rupee charge or increase in their platform fee may not be as noticeable a difference when you're booking on your Zomato app, but for the company, it's a big operational performance enhancer. How much is that? Well, as per Morgan Stanley, the blended take rate / contribution margin could increase by about 20 basis points, assuming that the company does around 85 to 90 crore orders in this financial year itself. 1 rupee increase is a higher addition to their EBITDA by about 85 to 90 crores, which implies that it could be around a 5 to 6% jump in their adjusted food delivery EBITDA itself. But remember, you have to keep in mind a couple of things. One, this hike is only in their key markets, which are that of Mumbai, Delhi, Bangalore, etc. Secondly, this net impact on financials should also be seen in context of discounted prices for gold membership renewals. Remember, there were a couple of discounts that the company had given for renewals of their gold membership itself. So the offsetting of that could be done via this platform fee increase. This is a dynamic number in nature. The company increases this platform fee on important surge days, etc. So let's see how that improves their overall performance. But the short point is that the food delivery business is doing extremely well, status quo in terms of growth rates and further improvement in their operational optionality. And then you have an increase of operational performance and growth in their Blinkit business, which again adds to the overall SOTP of Zomato. So brokerages are positive. Elara, for instance, has a rating of 280 rupees on the stock, a target price, whereas Morgan Stanley, that we spoke about earlier, has a target price of close to around 230 itself, very close to where the stock is currently trading at. That's about Zomato, but let's talk about the tech space. After TCS's strong show, HCLTech too reported decline less than what the street was anticipating, thus making these numbers slightly better than expectations, and the company held on to their revenue and margin guidance for this financial year as well. The stock is doing well, was among the top gainers on the Nifty in the morning, but then remember, it has already seen a 10.5% rally ahead of numbers, so as a result of which, some bit of cool off from the highs of this morning. We spoke with the management this morning to talk about the quarterly numbers, the outlook going forward, so hear them out. We'll come back and discuss more.
This guidance of 3 to 5% is something which we gave in the beginning of the year. And we did factor in the first quarter softness, which is quite similar to the previous years. And of course, Q2 is going to be a growth quarter, and Q3 is where we usually deliver peak performance. And at this point, we feel confident of the overall guidance for the year. In the last 7 quarters or 8 quarters, there has been kind of differing kind of signals that we've been getting, and sometimes the ramp ups are very short cycle and things like that. So that's why I've not called out any pickup in demand. The demand situation remains pretty much the same as what we had talked to you 3 months ago when we gave the annual guidance.
If you see even our last 2 years, the quarter to quarter trajectory has been, the first quarter is the weakest, around this 17% in both the previous years as well. And then it's the second quarter where we pick up to, let's say, somewhere around 18%. And then the third quarter is the peak, driven by the software seasonality, which is our most profitable segment, as you know. And then the fourth quarter is kind of near the annual average, again, just like Q2. So that's the trajectory, and we seem to be following that. The wage hikes, last year itself was a delayed cycle, delayed by a quarter for everybody practically. So we'll have to see what we do this year. We haven't still made the decision, as we discussed on Friday as well.
I think our overall bookings came in quite in line with our last few quarter trends. We have been clocking about $2 billion of net new TCV for the last several quarters, with the exception being the Q2 of last financial year, where we had a big spike in the deal wins. This quarter, we expected it to be a little more, maybe 2.3, 2.4, and a couple of deals got moved to the next quarter. It is really nothing to do with anything to do with the macro or anything like that. It is just that the logistics of getting an agreement signed got delayed, and we expect that to happen in this quarter. Pipeline remains pretty much at the same levels as what we had in the beginning of April. We are expecting growth in all verticals. We also expect to grow in all geographies. However, two things to call out. Financial services would decline because of the divestment that we had announced. And for the software business as well, it is a little bit weaker in the JAS July, August, September quarter.
All right, the other stock that we're talking about today is Aurobindo Pharma. We spoke about how there are a lot of long positions being added in the F&O space, but it's not without any fundamental reason. It's a 6% up move because the company will consider a buyback, Ekta?
Well, yes, Aurobindo is in focus because there will be a board meet on July 18, 3 days from now, to consider a proposal for a buyback. The gross cash on books is around 6,500 odd crores. The net cash is around 150 odd crores. Now, to specifically put it from their Q4 transcript, their gross debt was around $758 million, net cash around $18 million. And the business had a net cash inflow of around $12 million before the PenG capex in Q4. So now, according to analysts, the PenG capex is pretty much behind Aurobindo, and that is one of the reasons why they would be considering a buyback. And the quantum, however, is unlikely to be significant, according to analysts. It could be to the tune of around 1,000 to 1,500 odd crores. It would be Aurobindo's maiden buyback that they would be doing. But according to analysts, they are a little skeptical in terms of what the quantum would be. All right, I take that point. Thank you so much for that, Ekta. But let's talk about Ireda. That's the other one, which is up almost 4%. But over the last 1 week or so, it's been an even bigger mover. So it went into numbers with a big move, and post numbers as well. The stock is up 4%. Were the numbers as good? Abhishek joins in to tell us more. Abhishek.
Well, strong business momentum has aided the results this time around, although operationally, if you take a look, the operating profits have declined on a sequential basis. So take a look at the AUM growth. It's at about 33.9% YOY and close to 5.5% sequentially. Quarter-on-quarter, asset quality has improved. So gross NPA ratio has come down. Net NPA ratio has also come down by 4 to 5 basis points sequentially. Net interest margin has expanded both YOY and quarter-on-quarter. So net interest margin has come in at 3.29% versus 2.85% in the previous quarter. And our growth is at 37.5% YOY and about 5.5% sequentially. Now, operating profits have declined by 8.9% quarter-on-quarter. That's largely due to the fact that other income has declined on a sequential basis. There is a provision write back of 30 crore versus expense of 9.5 crore in the previous quarter, and that's aided the PAT this time around. PAT is up more than 30% YOY and about 13.7% on a sequential basis. Back to you.
Okay, all right. Thanks very much for that. Well, let's move on. But before that, we have some flashes on the screen where sources have indicated to CNBC-TV18 that GST Council's fitment panel has not yet considered a proposal of ATF and natural gas and ATF under GST. Remember that the GST Council can consider the request only on recommendation of the fitment committee. And oil ministry officials met with financial ministry officials. There's no commitment which is given on referring the matter to the fitment panel, and the FinMin has in fact expressed concerns over past disagreement with states on inclusion of natural gas as well as ATF under GST. So that's the update which is coming in at this point in time. So
very interesting to see how the stocks react to this, because there was a big rally all the way up to the GST Council meet where the street was hoping for some announcement of both ATF and natural gas coming into the fold of the GST. But now there is important clarification, and we'll probably get in Timsy to speak about that as well. The GST Council, the Fitment Committee has not made a recommendation yet, or this is not being considered as of now as per the news that is there. The Fitment panel is not yet considered the proposal of ATF and natural gas and ATF under GST itself. So as a result of which, could be a sentiment negative.
Yes, absolutely. Yeah, it could be a sentiment negative. In fact, the oil ministry officials met with the finance ministry officials, and they said there's no commitment which is given on referring the matter to the fitment panel as well. So we don't even have a timeline in terms of when there could be any kind of movement on this. So there's no commitment which is given on referring the matter at all. The finance ministry, in fact, expressed concerns over the past disagreement with states on inclusion of natural gas and ATF under the GST.
All right. So let's move on from this, and we'll get Timsy to speak about this in detail once we'll get some more details on this as well. But Varun Beverages is the other stock. When we were talking, earlier, the WPI had come by. Varun Beverages, the stock has moved higher to the high point of trade as it has gone ahead and informed the exchanges that they've entered into an agreement with PepsiCo to manufacture, distribute and sell Simba Munchies, the snacks, in Zimbabwe and Zambia. This agreement would entail an investment of up to 60 crores for the company, and this agreement would be effective from October 2025 for Zimbabwe and April 2026 for Zambia. This will give, this will be given a strong push by PepsiCo itself in certain fast-moving stock-keeping units through price initiatives as well. So all of this would work for the company. Remember, the snack food industry size in Zimbabwe and Zambia are close to around $150 to $170 million individually as of 2024. And the company, that's Varun Beverages, has already entered into an agreement with PepsiCo for manufacture and sale of Cheetos in Morocco. So why is this a positive development for Varun Beverages, even though on the surface it seems seemingly small with a 60 crore investment? One, it increases their engagement with PepsiCo. Remember, 59% of PepsiCo's revenue comes in from snacks. So increased engagement with PepsiCo and increasing share of revenue coming in from snacks would aid the company's business going forward. And secondly, it also leverages their own distribution ecosystem. So I'm already selling PepsiCo via the supply chain that I have. So, me selling snacks gives me additional revenue from the same ecosystem that I have. And that's a positive. And with all of this, can they do the same in India? If they were to do that, then it increases their market size by a lot more.
Okay, all right, Bangla. Well, that's on Varun Beverages. That stock is up around 1.5%. HDFC Life is in focus because it will be reporting its Q1 FY25 earnings. Yash joins in to tell us what the street is anticipating. Yash? Okay, well, maybe we'll just get back to Yash in just a bit. He's probably, his audio is, our audio is probably not reaching him. But nonetheless, on that note, we'll take a short break. On the other side, we'll focus on Tyre stocks, which are surging in trade due to price hikes. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Important news at the bottom of your screen with regards to the inclusion of natural gas under GST. But this is our special segment, which is Value Plus. We focus on the Tyre stocks, which have been the driving force in today's trading session when it comes to a sectoral move on the back of price hikes that have come in. Let's focus on a lot of individual stocks which are, buzzing around on account of this price hike. And then we talk about the commodity itself. Sonia joins in with the price hike update, the latest one being MRF.
Absolutely. Thanks a lot for that. So, if you look at it, there has been a price hike across the board for most of these tyre companies. And the one that we're looking at this afternoon is MRF. MRF has announced a price increase effective 18 July. Truck tyres have been hiked by approximately 2%. Passenger car and radial tyres prices have been hiked by in the range of 3 to 7%. So far, there's been no hike in two-wheeler tyre prices, but the blended price increase works out to be about 2%. Now, this is the first price increase that MRF has taken in order to pass on the higher raw material costs to consumers, specifically rubber and crude that is used in the manufacturing of tyres. Now, if you look at it, the other players like Apollo, SIAT, JK Tyres have already taken approximately 3% price increases, and the price increases still lag the cost increases that have been seen in the last 3 to 4 months. So despite the prices being passed on to consumers, there could still be some margin pressure that the companies face because of higher rubber and crude oil prices. So overall, yes, it's a positive for MRF, the fact that demand is strong enough that they were able to pass on the price increases to customers. Back to you.
All right, that explains the up move on these stocks. And like Sonia pointed out, one of the key reasons for this price hike is the increase in rubber prices itself. And if you're watching this show on a regular basis, you would not be surprised by that, largely because Manisha has been telling us about the increase in rubber prices and the fundamental reasons for the same as well. Manisha joins us to apprise us once again of the happenings in the rubber industry. Manisha.
Well, thank you for that, Mangalam. Yes, if you look at the rubber prices, this is after a very long time that we have seen prices run up above 200 rupees a kg. This is the highest in 13 years. And that is because in the previous season itself, we've had heat waves. So the production has been lower. Productivity has been a concern as well. And then you clearly have to look at the global markets as well, where the rubber study group says that for the year 2024, while the consumption will increase by 3.1%, the production will increase only by 1.1%. So globally as well, we are looking at very bullish trends when it comes to rubber. For the Indian markets also, while the production and consumption mismatch continues, remember, India does depend on the international market for anywhere between 4 to 5 million tons of rubber that we do import here. And the demand has been quite strong from the tire sector, as Sonia was pointing out, and from the non-tire sector as well. The rubber product exports have been on the stronger side as well. The only concern that the industry really sees is the 25% import duty on rubber. But apart from that, the kind of demand growth that we are seeing in case of rubber on a quarter-on-quarter basis, year-on-year basis has been much on the higher side. So that tells you that the rubber prices are here to stay above 200 and can even see further gains from here on.
All right, Manisha, thanks a lot for that. So that's about the rubber prices. In fact, like we said, last week we had this conversation. Manisha was speaking with Rajiv Budhraja, who's the General Director at Automotive Tyre Manufacturers Association, or ATMA as we know it, when he spoke about companies which are concerned about their rubber availability, even as at elevated prices, domestic rubber is just not available. So not only are the prices higher, there is not elevated prices. So what's the outlook for this industry, this commodity itself? Let's hear out those comments.
Year record high, having crossed 200 and now, hovering around 205 and 6 mark. That itself is, from the consumer perspective, a point of concern. But I think more than that, it's the availability, that is sort of, become a major concern for the tire companies. Even at these prices, domestic rubber is not available. And there is hardly any visibility seen, going forward also for multiple reasons. So at this point of time, both price and its domestic availability are the two major concerns for the tire industry.
All right, so the tire industry in focus. Tire stocks are higher because the companies have gone ahead and taken price hikes. Important to see whether these price hikes will actually aid their margin or just mitigate the increase in their cost itself. And would there be an impact on demand on account of these price hikes? In any case, the current quarter that we're in, the monsoon quarter, does not see elevated demand for tires. How that pans out in terms of an up move for their EBITDA and EPS is something we'll watch out for. But that's about the tire space, value plus segment. Take a short break, come back on the other side. Manisha still with us, speaking about all things commodities, and she has with her Kunal Shah of Nirmal Bang.
Welcome back, and joining us now is Kunal Shah of Nirmal Bang. Kunal, hi, welcome. And this is a data-heavy week. I mean, we've started on Monday morning with various numbers coming in from China, but that hasn't had a very major impact on many of these industrial commodities because the markets believe that the China plenum meeting perhaps wouldn't really focus on real estate, but rather on manufacturing and other areas. How are you looking at those numbers, and what's your sense?
I believe that China has to focus on real estate. They cannot ignore real estate because 25% of their GDP comes from the real estate sector, and that has been reeling. So in the month of February, March, we've seen a good rally in the prices of base metals, and eventually in April, May, June, it fizzled out. So I believe that in this 5-year planning meeting, which is going to go for next 3 days, we believe that there is going to be a significant announcement on how to revive the real estate market, and that is going to be very bullish for metals. So right now they are subdued. The economic data from China has come disappointing, but I believe that something is in the store. In this meeting, you are going to see China may come up with some announcement about how they are going to stimulate their real estate market, the property sector. and that will lead to a spike in metals, and major short covering is expected. So I recommend to remain long in base metal complex, at least for this week, and I'm expecting in next 2-3 days announcement from China about how they are going to revive their real estate sector. It is difficult, but they will be taking some of the other measures in order to revive this critical sector, which is leading a major drag on their economy. So I'm bullish on base metals.
All right. So bullish on base metals, at least for the current week, if not more. But Kunal, within the space as well, where do you see buying opportunities?
So if you see right now, the inventory of copper on LME is increasing, inventory of zinc is increasing, and that is basically leading to correction. So whichever metal is fundamentally bullish. So there are two metals which I like fundamentally. One is copper, another is aluminum. So these are the two metals where I recommend to go long going forward. And copper around current levels, 860 to 855, good levels to go long. You can expect copper to shoot up to levels of 905, 910. As far as aluminum is concerned, 225, good levels to go long. 235, 238. These are the kind of levels which you can expect to see in aluminum going forward. So copper and aluminum remains our top bet.
Fair point. Also talk to us about precious metal prices, because the Powell testimony yet again today. We've heard two speeches in the previous week, another one coming in today. Are you looking at support from this one as well for gold and silver? Because most of the economic data that we've seen come out from US are supportive of a rate cut now in September.
I think it's a no-brainer. We are going to see a rate cut. The reversal of rate cut cycle is going to start from the month of September. And in all this testimony, Mr. Powell is trying to reassure, that look, we have no option but to cut the rates. Inflation is coming down, job market is weak, the housing prices have started to go down. So all the reasons for them to, do the reversal of rate hike cycle. They cannot afford to keep 5.5% interest rate for a longer period of time. So I think there will be an indication coming from Powell to cut the rates in the month of September, because in the month of August, we don't have the Fed meeting. So September will be the month we are going to see the first rate cut from the US, and that will be overall sentimentally positive for all the commodities.
Fair point. That's something to watch out for. And well, yes, the CME Fed Tool Watch does show that there is a 93% probability now of a rate cut coming in for the month of September. That perhaps would be supportive. Kunal, as always, thank you so much for joining us and making sense of what really is working with metal prices right now. But with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.